Okay, good morning, guys. Good morning. I think my sound was off earlier. Okay, am I audible now? Am I audible now? I think the sound was, I was not audible. Am I audible now? Am I audible now? Good morning, guys. Good morning. Now, am I audible? Good morning, everyone. Yes, and welcome to this amazing morning. And yes, a Navratri morning. And guys, Navratris are the best and auspicious days to start something new. So if you want to start a new subject, if you want revision of your existing subjects, if you want to pick up another group and start studying, these days are the most auspicious one. So, just grab hold of these days. These are very auspicious days to start something new. So start studying a new subject during these days and you will find immense success in that particular subject if you start those subjects during these days. So very auspicious days for all of us, and a very good morning to all of you. Welcome to this session. And yes, this session we will discuss the most important, the most coveted, the most talked about chapter of our syllabus, which is PGBP, Profits and Gains of Business and Profession. That is what is the agenda of today's session. All right, good morning Shipra, good morning Om, good morning Kirti, good morning Yogesh, Ravi, Debrata, Sumit Ghosh, Vanshi, Anji Reddy, Vishnu Prasad, Rajashri, Deeptesh, Jyotish, Yashika, Megha, Pankaj. Good morning, Nandini, Sangeeta, Shalu. Good morning, everyone. A very good morning. And yes, let's start our chapter. The name of the chapter is PGBP. And yes, guys, this particular chapter is not only relevant for CMA intermediate students, but it is also relevant for CMA final students. So, guys, the entire chapter of PGBP is equally important for final students as well. So, whatever is the course content of CMA intermediate, it is applicable to CMA final students as well. So, CMA final students also must look at this video very closely, must study from this video very closely, because this is relevant not only for CMA intermediate but for CMA final students as well. As CMA final students already know, their book does not contain, their study material does not contain PGBP chapter. So it is to be extracted from the CMA intermediate study module as it is. So CMA study module contains PGBP chapter that is applicable for CMA final students as well. Same goes for chapters like capital gains. Guys, capital gains is not there in CMA final study material. That capital gains should be derived from CMA intermediate study material. So whatever chapters are there in CMA intermediate study material, those are equally relevant for CMA final students as well. Yes, that is how your curriculum is planned. That is how your curriculum is structured. Okay, so let's start one of the most important chapters of our syllabus, which is PGBP, Profits and Gains of Business and Profession. And guys, this chapter needs no emphasis. This is the most important chapter of your syllabus. And from an exam standpoint, this chapter is really important because it commands huge weightage, not only from your exam standpoint, but also apart from exams, your practical life also. If you happen to enter into direct taxation field, if you happen to enter into a consultancy of direct taxation, or some kind of stream which is related to direct taxation, then guys, this is one and only most important chapter, most important head of your practical life as well. So in my career of past 10 years of working for the big fours, I have worked almost 10 years in the big four in their direct taxation division. And guys, 90% of the times, 90% of the times I have referred only and only to PGBP sections, section 28 to section 44. 95% of the times I have referred only to PGBP sections. That is how important PGBP chapter and PGBP sections are to all of you. Not only from an exam standpoint, of course, from an exam standpoint, it's very important, but from standpoint of your practical life, when you go to industry, when you start your own practice, and you happen to do direct taxation as one of your subjects and as one of your practice methods, then guys, PGBP will definitely take a major portion of your career, major portion of your working life as well. So PGBP, I'll broadly discuss what all things are we going to discuss in PGBP chapter. Okay. So these are the contents of PGBP chapter. These are all the things that we are going to discuss in PGBP chapter. First of all, we are going to discuss the difference between business and profession. This is exactly the same as we have studied in our 11th standard business studies book. Okay, it is exactly the same. Business and profession, the difference between business and profession, standard 11th business studies book, it is exactly the same. Then we are going to discuss about incomes and expenditures which are allowable under PGBP head. And guys, this is a constant feature of all the 5 heads of income, that in all the 5 heads of income, we are continuously repeating this element, that under all 5 heads of income, we are talking about 2 things: incomes which are taxable under that head, and expenses which are deductible from that head. That is what we are discussing in all the chapters consistently. So that is the second ask which we are going to study. And yes, guys, in this particular chapter, expenditures will be a little detailed, which means expenditures will have 2 elements: general expenditures and special expenditures. The deductions are of 2 types under PGBP. It is only under PGBP that this happens, that deductions will happen to be the most critical thing which we are going to analyze. And they are of 2 types: generic deductions, or specified deductions, or special deductions. Okay. And one of the examples of general deductions is depreciation. Guys, depreciation is allowable as a revenue expenditure from computing the income from PGBP. Then there will be certain special deductions also. So what do you mean by special? What is so special about them? We'll be studying it. Then we'll see what is so special about these special deductions. Then we have disallowed expenditure. So guys, some of these expenditures will be disallowed due to certain non-compliances. Some of these expenditures which we'll be studying over here, which usually is allowable, those expenditure we will not allow, because there'll be some miscompliances which will happen. Because of the miscompliance, we will not allow the deduction of certain expenditures under the PGBP head. That is the head of disallowed expenditure. That is the meaning of disallowed expenditure. That is what we are going to study over here. Then next is maintenance of books of accounts and tax audit. Of course, the tax officer or the income tax department needs to be sure that you have prepared your books of accounts properly. You have complied with all the sections which are given under Income Tax Act. The Income Tax Act needs to be sure about that. Hence, there are provisions of maintenance of books of accounts and tax audit. Tax audit being one of the most important sections of this particular chapter. And last, we are going to study presumptive taxation. What do you mean by presumptive taxation? Presumptive taxation means where the taxation happens on an estimate basis. We are not able to reliably form a profit and loss account and compute the income of that particular business. We are just trying to presume or assume certain numbers to tax this particular business. That is known as presumptive taxation. On the basis of presumption, or on the basis of guesswork, we'll be estimating the income of certain businesses, because those businesses, maintenance of books of accounts is not happening, is not possible also. So for those businesses, we have presumptive taxation regime, where books of accounts will not be maintained, and we'll be assuming certain profit and loss to be income of those kind of businesses. Yes, it sounds weird. You would be thinking, that's a what weird thing are you saying, that we will assume certain profits, we will assume certain income in these businesses. But yes, guys, that is so. There are certain businesses where the income is assumed. This is known as presumptive taxation. All right. So these are the various elements of PGBP chapter which we are going to study in this particular session. Yes, we will not be able to complete all the topics in today's session. So we'll be carrying it forward till Thursday, or maybe one more session is required for PGBP. But now, guys, we are going to start the first and the basic concept of PGBP. What is the difference between business and profession? So, guys, the basic difference between business and profession is that business is a recurring economic activity. Any economic activity which is recurring, that is known as business. Any economic activity which is recurring, that is known as business. So business is any activity which is recurring. It includes trade, manufacture, or commerce. It includes trade, manufacture, or commerce. And profession means something where application of skill is required. Where skill is being applied, that is known as profession. Where you're not selling or purchasing any goods or services, you are applying your skill, which means you are an accountant by profession and you are applying your accountancy skills. You're a doctor by profession, you are applying your medical skills. You're an engineer by profession, you are applying your mechanical or any kind of engineering skills. So those are known as professions. So business or profession, any income which is earned from either of these two heads, that is known as business or profession income. PGBP, profits or gains of business or profession. Application of skill acquired through special learning qualification like doctor, CMA, etc. These are known as professionals. Includes vocation also. What do you mean by vocation? Guys, vocation means you've seen all these reality shows which are booming up in TV these days. Reality shows like Dance India Dance, or Superstars Ki Khoj, or Hunarbaz, Kaun Banega Hunarbaz. So these are the reality shows where small kids come up and they showcase their talent. New generation, young generation come up and they showcase their talent. This is known as vocation. And in case of vocation, guys, income is taxable as a profession itself. So vocation, profession includes vocation. Profession includes vocation. Natural talent of a person like singing, dancing, acting, or any kind of magician. If a kid is a magician, okay, all these are known as vocation. So vocation are taxable. Income from vocation is also taxable under profession. So profession includes vocation as well. Now guys, we get to now study what are the incomes which are taxable under the head PGBP. What are various kinds of income which are taxable under the head PGBP? Section 28 is the relevant section. So the incomes which are taxable under the head PGBP are any kind of income from business or profession, including any speculative business. And guys, even if you have earned any income from an illegal business, that is also included under PGBP. So Income Tax Act doesn't differentiate between a legal income and an illegal income. Any kind of income which you have earned, Income Tax Act will say pay taxes on that. Yeah, that is a different thing, that if you are earning illegal income, then you will be charged under the legal provisions of criminal acts as well, civil or criminal acts as the case may be. They will be charged upon you. You might be devoid of your income which you have earned from illegal sources. That can also be the situation. But Income Tax Act says even if you have earned illegal income, even if you have earned income like income from speculative business, then that is also taxable under the head PGBP. So Ishita Khemani says, sir, under your vocation types show like Shark Tank is included. No, Ishita, Shark Tank is not included under vocation. Why? Because Shark Tank, the money is not being earned as income. It is being infused as capital. So whosoever is appearing in Shark Tank and the person who's getting money, getting funds, he's not getting income. It is not revenue income. It is capital which is being infused in his business. It is capital receipt. It is not income. So if I go to Shark Tank and I request the judges to fund my business, my business of coaching, I want to expand my coaching to outside the country, outside India also. I want to expand in the United States of America. I want to expand in Australia. I want to expand my coaching. If I ask for funds from them, they give me funds. Suppose they give me funds of 1 crore rupees. They are not my income. They are not my income. That is capital infusion in my business. That is not income. That will not be charged as income. It is capital infusion. So that is not a vocation. It is a source of capital of any business. Okay, sir. Someone is saying Big Boss. Ravi Gupta is saying Big Boss. Ravi Gupta, you only see these kind of TV shows like Big Boss. Nalayak. All right, compensation to management agencies. So guys, there are certain management agencies who would undertake to run your business. So if you have a business and you want some professionals to run your business on your behalf, obviously under your supervision, then the money which management agency receives for providing such kind of services, that will be taxable as PGBP. Any income from trade or professional association for providing services to its member, any kind of trade or professional association like trade association like FICCI, trade association like ASSOCHAM, any kind of trade association which derives income from providing services to the member, that is taxable as PGBP. Any export incentives like sale of DEPB, duty entitlement passbook, duty drawback. So guys, when you will study customs in your group 2, then you will understand what do you mean by duty drawback, what do you mean by DEPB. These are the benefits which are derived by any exporter on exporting of goods or services. So any kind of this benefit which is derived by the exporter, that is also taxable as PGBP. Remuneration to partners of firm or LLP, including interest, bonus, commission, salary, everything is taxable as PGBP. So if any partner gets anything from the partnership firm, so what if partner is getting salary from the partnership firm? Even then it is taxable as PGBP. because partner and the partnership firm are not two different people. They are one and the same people. Since they are one and the same people, therefore, guys, any income which is received by the partner from the firm, that is taxable as PGBP income in the hands of the partner also, not as salary, not as salary. So partner, even if it is he is getting salary, it is not taxed as salary. Okay, sir. The non-compete fees or exclusivity agreement. Now, guys, there is some non-compete fee which might be payable. So, for example, there are two brothers. Both the brothers are engaged in their family business of, say, jewelry making. Now, one of the brothers tell the other brother that you leave this business and you do not do this business for next 10 years in this particular area. I will pay you 1 crore rupees for not competing with me, for not coming in this particular business for next 10 years. That is known as non-compete fees. So, guys, non-compete fees is also taxable as income. Although it is not earned for running business, it is earned for leaving business. It is earned for not running business. Then also non-compete fee is taxable as PGBP in the hands of the recipient. Exclusivity agreement. If you have some agreement of exclusivity with someone, which means that you are exclusively dealing with certain goods, and you want in future also you deal with these goods exclusively, then that exclusivity agreement is taxable as PGBP in your hand. So whether you are entering into a non-compete fee kind of an arrangement, which is again kind of exclusivity agreement only, or if you are dealing with the exclusivity agreement, both the incomes, although they are not earned for running the business, they are earned for not running the business. That is the moot point of consideration. They are earned for not running the business. You are forbidding someone from running this business. Even then, guys, these two businesses will be taxable as these two incomes will be taxable as PGBP. PGBP will be the relevant head under which these two incomes will be taxed. Then some received from Keyman insurance policy. Keyman insurance policy means the policy which is taken for topmost professionals or topmost management board of directors, etc. of the company. So for those people who are the key man of the company, key man means the top directors, board of directors, the managing director, etc., etc. So any amount received from Keyman insurance policy is also a PGBP income. Then income from illegal business is definitely a PGBP income. Then what do you mean by notional profits? Notional profits means anticipated profits which are not taxable. Notional profits means anticipated profits which are not taxable. So profits which are anticipated, which we think that we will get, but we have not actually got them. So anticipated profits or notional profits are not taxable. So if we think that this profit is going to be earned by us, but it is not actually earned by us, then that is known as notional profit or anticipated profit. It is not taxable. Dividends on shares and winning from races, lotteries, etc. is taxable as income from house property. So any dividend received from shares or winning from race horses, lottery, etc. is taxable as income from other sources. Is taxable as income from other sources. So, guys, although income from other sources. So although, guys, you might be in a business where you have earnings from race horses, you might have earnings which you have earned from races or from lotteries, etc. But guys, these income are chargeable to tax under income from other sources head. Similarly, dividends on shares are also taxable as income from other sources head. These are not business income. These incomes are taxable as income from other sources. That is the consideration. Okay, sir. Okay, now, guys, let us start the most important topic of this particular chapter, the most critical topic of this particular chapter, and students are very, very afraid of this particular chapter, of this particular topic of this particular chapter. So the topic name is deductions. Topic name is deductions. What are the expenses which will be reduced while computing the income from PGBP? Now, my question to you is, from point of view of the Income Tax Act, from point of view of Income Tax Act, and your hands on the keyboard, from point of view of Income Tax Act, guys, higher the expense, better it is, or lower the expense, better it is. From the point of Income Tax Act, from the point of view of Income Tax Act, higher the expense, better it is, or lower the expense, better it is. Please write in the chat box, higher the better or lower the better in way of expenses. Yes, Jyotish, you are right. Jyotish, you are right. From point of view of Income Tax Act, higher the expense, better it is, or lower the expense, better it is. Very good, Pankaj. Very good, Megha. Saksham. Ishita is wrong. Deepika is right. Anshul is right. Deeptesh right. Aditi right. Ravi Gupta right. Nandini right. Sadanand right. Bhavika right. Yashika right. Sumit right. Vanshi right. Deepika right. Miraki right. Shipra right. Shipra wrong. Rani right. Vishnu right. Kirti right. Very good, guys. Very good. From the point of view of Income Tax Act, lower the expense, better it is, because if the expenses are low, then income tax will be high because profit will be high. So from point of view of Income Tax Act, lower the expense, better it is. Lower the expense, better it is from the point of view of Income Tax Act, because then taxes will be higher. And guys, from the point of view of assessee, from the point of view of all of us, the business owner, lower the expense, better it is, or higher the expense, better it is. What will we want? As a businessman, what will I want? Do I want higher expenses or do I want lower expenses as a businessman? Pankaj, perfect. Pankaj is right. Yogesh is right. Aditi right. Vishnu right. Anshul, Om. Devadatta, Sarnikya, Namrata, Vishnu, Vanshi, Jyotish, Yashika, Garima, Saksham, Rani, Deeptesh. Very good answer, guys. Very good answer. Very, very good answer. Very good answer. Higher the expense, better it is. So assessee will always want that its expenses should be higher. And the Income Tax Act will also always want that the expenses should be lower. So that if the expenses are lower, then the profits will be higher. If the profits are higher, then taxability will be higher. So Income Tax Act will want lower expenses. However, we as assessees, we as the person who's paying taxes, we want higher expenses. That is a fight which will always go on between the Income Tax Act and the assessee. So this fight will be resolved by discussing this topic known as deductions. So these deductions will precisely tell us what expenses are to be allowed while computing the PGBP income. So there are two kinds of expenses: specific expense or generic expense, and special expense. Generic expense means revenue expenditure relating to carrying of business or profession. Any kind of revenue expenditure which is related to carrying of business and profession is to be debited to the profit and loss account, which is prepared as per the tax books, is to be debited to the profit and loss account. Now my question to you is, and your hands on the keyboard, guys, what if capital expenditure is being incurred? What if capital expenditure is being incurred? Where is capital expenditure debited to? Is it debited to profit and loss account, or is it debited to somewhere else? Please write in the chat box. Where is capital expenditure debited? That is my question. Because revenue expenditure is debited to P&L account, that we are very sure. We are very sure about it. But where is capital expenditure debited? Like I have purchased some machinery, I have purchased some fixed assets, I have purchased some vehicle. Where would I debit those things? Please write in the chat box. Where would capital expenditure be debited? Good morning, Himang Singh. Balance sheet, balance sheet. Very good. Nandini is wrong. Not profit and loss account, but balance sheet. Somewhere else. Tanisha is fantastic. Tanisha is saying somewhere else. I don't know where, but somewhere else. Megha Tomar is saying somewhere else. Balance sheet is the correct answer. That the capital expenditure will be debited to balance sheet, and revenue expenditure will be debited to the profit and loss account. So revenue expenditure which will be debited to the profit and loss account, those revenue expenditure are the eligible deductions. Those revenue expenditure are the eligible deductions. So any revenue expenditure relating to carrying on the business, that is debited to P&L account, right? For example, rent, rate, taxes, depreciation. repairs, maintenance, employees' salary, etc. So there are two kinds of expenses which are written over here: specific expenses and general expenses. Specific expenses means those revenue expenditure which are stated in a particular section, like section 30, 31, 32, etc. There are certain expenses which are stated specifically in the in a particular section, and there are certain general revenue expenditure. General revenue expenditure means which are not mentioned in any specific section, but they are debited to business profit and loss account. So the generic sections are not mentioned anywhere. The generic sections, the generic profit and loss account sections, the generic expenses are not mentioned anywhere, but they are debited to the P&L account. Section 37 says all the expenses which are incurred for business purpose are to be debited to the profit and loss account. Now this is about revenue expenditure. Now guys, I'm going to deal with special expenditures. Now I'm going to deal with special expenditure. As I have already told that there's something special about these expenditure, therefore these are known as special expenditure. Please write in the comment box, can capital expenditure be debited to P&L account? Please write in the comment box. Can capital expenditure or should capital expenditure be debited to P&L account? Yes or no? I want answer in yes or no. Can capital expenditure be debited to P&L account? Anshuli Yadav says yes. Anshuli Yadav, where have you seen capital expenditure being debited to profit and loss account? Huh? Where? Answer is no. Yes, right. No, no, no. Bhavika is also saying yes. I don't know where Bhavika has seen capital expenditure being debited to profit and loss account. Where have you seen Bhavika? Om is right. Vishnu is right. Very good, guys. Very, very good. So, guys, since our 11th standard, we have studied that capital expenditures are not to be taken to profit and loss account since our 11th standard. But under certain special circumstances, if you fulfill certain specified considerations, certain specified conditions, then I will allow capital expenditure to be debited to P&L account as per the Income Tax Act. Yes, this is a big, big, big benefit which is provided by Income Tax Act. Therefore, this is known as special deduction. This is a big benefit which is being done by the Income Tax Act, which has been proposed by Income Tax Act. If you fulfill certain conditions, if you fulfill certain preconditions, then the capital expenditure can also be debited to profit and loss account. This is a special deduction case. But yes, guys, naturally, not in all cases. No, 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 no. Not in all cases. This doesn't happen in all cases. This happens only in specified cases where certain conditions are met. So these are known as special deductions. I told you there has to be something special about it. Something which is not usual. Special means something which is not usual. And yes, this is something which is not usual, that capital expenditure allowed as a deduction under certain specified circumstances. For example, scientific research expenses, expenditure on purchase of plant and machinery, etc. So these are known as special deductions. And yes, if you want these special deductions, you have to fulfill certain terms and conditions which are given under the Income Tax Act. Okay, sir, got it? So when we'll come to special deductions, then we will see what are those special terms and conditions which are to be fulfilled for claiming deductions of these special special deductions. Yes, sir. So deductions are of two types: general deductions and special deductions. And now we are going to start with general deductions first. Then we are going to start with specific deductions. So the first general deduction which we are going to start today is the most important general deduction, which is depreciation. And on the chat box, I want to know, why is depreciation levied? Why is depreciation levied? I want to know in the chat box. Okay. The first and foremost deduction which we have in our syllabus is depreciation. My question to you is, why is depreciation levied? What is the reason why we levy depreciation? Why this expense is incurred? What is the reason why this depreciation is levied? Please write in the chat box why depreciation expense is levied. In the chat box, why is specified deduction, why is depreciation levied? What is the reason? What is the reason for depreciation being there? what happens that depreciation is levied? That is the question that we are going to ascertain. Perfect, Megha Tomar. Perfect, Kirti Batra. Very good. Tanisha Kanojia, very good. Wear and tear and technological obsolescence. These are the two reasons. Wear and tear, Ravi Gupta, very good. Yes, guys, you are absolutely right. The reason why the assets are depreciated is that wear and tear of assets happen. Deeptesh, Rani, Hardik, Rajashri, Vishnu, Saksham, Pankaj, very good. Wear and tear, very good, guys. So depreciation is levied due to wear and tear. When you actively use a particular asset again and again and again, then wear and tear happens, and thus the depreciation is levied. The other reason for depreciation to be levied is a flux of time. So if you have purchased a particular asset and you have put to use, you've installed it, but you have not used it, then guys, even then your time is running away, your time is passing by. So due to efflux of time, also depreciation is levied. So depreciation primarily is levied due to wear and tear. Then who can charge depreciation? Only the legal owner or the beneficial owner can charge depreciation. The one who has his name in the records, in the registered deed of that particular asset, that particular person can claim the depreciation. Obviously that asset should be in your name, so the bill should be in the name of the company. If the company wants to claim depreciation, then the bill of that particular machinery should be there in the name of the company. Only then the depreciation will be claimed. Or the beneficial owner can also claim depreciation. So if all the benefits of a particular asset is being enjoyed by a person, despite of the fact that he is not the legal owner or the registered owner of that particular asset, even then, guys, the depreciation is claimable by the beneficial owner. So sometimes the documentation of transfer of ownership takes time. So till the time when documentation is happening, till that time beneficial owner can claim depreciation. Then how is depreciation charged? Depreciation is charged on the method WDV method on block of asset. Guys, in case of financial accounting, we charge depreciation only on SLM case. Okay, in case of financial accounting, we charge depreciation only using the SLM method, straight line method. But in case of income tax, we charge depreciation only on WDV method. There is only one exception to this rule, which we are going to study in our subsequent classes. WDV method is used on block of assets to charge depreciation under the Income Tax Act. Can SLM be used? Answer is no. SLM is not used. Only one exception is there, power generating units, where SLM is used. That we are going to discuss separately. But otherwise, the generic rule is that only WDV method is eligible on block of assets to ascertain the depreciation of a particular asset. Then rate of charge, there are specific depreciation rates which are given under the act. So depreciation is chargeable only using those specified rates. Those specified rates will be reduced to 100% of the rate or 50% of the rate, depending upon the use of the asset. So if the asset is used for more than equal to 180 days in a particular year, if the asset is used for more than equal to 180 days in a particular year, then 100% of the prescribed rate of depreciation is charged. If the asset is used for less than 180 days in a particular year, then 50% of prescribed rate of depreciation is charged. So in case of financial accounting, guys, we prorate the depreciation on the basis of number of days also. So if the asset has been purchased, say on 15th May, then even 15 days depreciation will be charged. But this is not the case in income tax. Income tax has made it little easier. Income tax had just said that if the assets are being used for more than 180 days, then 100% of the depreciation rate is applicable. So if the depreciation rate is, say, 20%, then 20% depreciation will be charged. But if the asset is used for less than 180 days, then half of the depreciation, which means only 10% of the depreciation, will be charged in that particular year. Then in case of mixed use and professional, personal and professional joint ownership of the asset, depreciation is to be split on the basis of number of days used. So if you have used your depreciation, your asset partly for personal use, partly for business use, then guys, the depreciation will be split amongst the two things. Then joint ownership of asset, if asset is being owned by two owners are cumulatively holding a particular asset, then also depreciation will be split into two parts based on number of days of depreciation of asset used by each of the joint owner. That is the rule. Okay, sir. So how do we compute depreciation in this particular case? This is the chart which is showing computation of depreciation. How is depreciation computed? This is the chart which is showing that. Okay, so we take opening WDV, then we add purchases to the opening WDV. We take opening WDV. WDV means written down value, which is the value which is the closing value of the previous year, that is taken as opening value of the current year. So opening WDV, add assets purchased during the year, less sales proceed of assets sold during the year. Whatever assets are sold during the year, its sales proceeds is reduced. Please note, please note, please note, in financial accounting, we do not reduce the sales proceed, we actually reduce the book value of that particular asset over here. That is the difference between financial accounting and income tax. In case of financial accounting, we reduce book value of assets over here. However, in case of income tax, we reduce sales proceed over here. I'll give you an example. Okay, I purchase an asset for 20,000 rupees. Depreciation rate is 10%. So after 1 year, the value of the asset, book value of the asset, is 18,000 rupees. Now, suppose that particular asset was sold in 19,000 rupees. Then, guys, as per the financial accounting, we will reduce 18,000 over here, which is the WDV of that asset. However, as per the Income Tax Act, we will reduce 19,000 over here and not 18,000. That is a slight difference between the method which is adopted for computing depreciation in case of financial accounting versus the method which is adopted for computing depreciation in case of income tax. That is the difference. Okay, so next, WDV. This cannot be negative. WDV is the residual figure. Then less depreciation, we put depreciation on this WDV. Depreciation and the closing WDV is computed like that. Okay, so this is the chart which will tell you how to compute depreciation in case of income tax. And the major difference which I can see in this computation as compared to the financial accounting computation is the sales proceed. That is the major difference which is there over here. Yes, please, Ravi Gupta, 4th October is the right date for 180 days more or 180 days less, right? 4th October. Okay, so A, B, C, D, I have written down the formulas over here. B is the assets which are purchased in case purchases during the year. In case purchases during the year have been put to use for less than 180 days in the year of purchase, then depreciation is charged at 50% of the normal rate. So that is the thing which we had discussed earlier as well, guys, that if the assets are being used for less than 180 days, then 50% of the normal rate will be applicable. Then date of sale of asset is irrelevant. When the asset has been sold, that is irrelevant. Whether it has been sold after using it for more than 180 days, less than 180 days, that is irrelevant. Sales proceed will be reduced in its entirety from the closing WDV. Okay, in its entirety. Depreciation is not charged in the following cases: when WDV is negative and when WDV is positive, but the block doesn't have any asset. In such a case, positive balance is equal to short-term capital loss. So there are two cases where depreciation is not charged. There are two cases where depreciation is not charged. A, this WDV becomes negative or it becomes zero. So it cannot become negative. So it will at max become zero. So when WDV is zero, then we don't charge depreciation. Or when WDV is there, but the block ceases to exist. What do you mean by block ceases to exist? Block ceases to exist means that there are no assets in this particular block. All the assets have been sold. Although some WDV has been left, because there might be a difference between the opening WDV and the sales during the year. There might be some WDV which is left in terms of monetary value, but the assets are not there in this particular block. Assets have ceased to exist. Assets have finished from this particular block. Under these two situations, depreciation is not charged. In the following cases, depreciation will not be charged. These are the two cases where depreciation is not charged. And guys, trust me, you have to do question number 1 of or your study mat. I don't know from where have you taken coaching of direct taxation, but wherever you have taken coaching from direct taxation, open your book CMA study mat. I'm talking about CMA study mat, CMA Institute study mat. Open that study mat. PGBP chapter of intermediate. Even this advisory is also for final students. CMA intermediate, PGP chapter. Open study mat. Illustration number 1. Case A to case O. Case A to case O. Just do all those questions and your entire depreciation computation will be covered from that particular question. A beautiful question which has been prepared by CMA Institute. and that question will cover, or the permutation and combination which will come to you for computation of depreciation, and all your doubts with respect to depreciation will be covered in that particular question. So one question, illustration number 1, case A to case O, all your doubts with respect to depreciation will be covered from that particular question, that particular illustration. So that is what I would advise you to do. Question number 1 of PGBP chapter, illustration number 1 of PGBP chapter. Now, sir, please tell us that are there any specified rates which are okay? Jyotish is asking one question. Jyotish is saying, if the year of purchase and capitalization is different, then will that 180-day rule work? So guys, this 180-day rule will not work if your purchase date and your put to use date is different year. So I'll give you an example. Let me give you an example. So I have purchased my asset on 1st November 2022. I have purchased asset on 1st November 2022. Now I have put to use this particular asset on 1st January 2023. I have put to use this asset on 1st January 2023. This asset is having a depreciation rate, say, of 10%. Okay. Say of 10%, the depreciation rate is there. Please tell me in the chat box for financial year 2022-23, what is the depreciation? Please tell me in the chat box. The asset is worth 2 lakh rupees. The asset is worth 2 lakh rupees. The asset which is purchased is of 2 lakh rupees. Asset is worth 2 lakh rupees. I have purchased it on 1st November 2022. I put to use that particular asset on 1st January 2023. Please tell me the depreciation for amount of depreciation. I'm talking about amount of depreciation for the financial year 22-23. What is the amount of depreciation for financial year 22-23? So it is 2 lakh multiplied by 10%, 20,000 divided by 2. Perfect. The correct answer is 10,000 rupees. The correct answer is 10,000 rupees. 50% will be the depreciation. Anshul Yadav is wrong. Yes, right. Perfect. Great, guys. Great going. So the put to use date, since it is less than 180 days, the depreciation will be, which will be charged at 10,000 rupees. Now, I'll change my question a little bit. Okay. I'll change my question a little bit. So this particular asset is put to use on 1st April 2023. This particular asset is put to use on 1st April 2023. Now please tell me, what is the depreciation which will be charged in financial year 22-23? What is the depreciation which will be charged in the financial year 22-23? The depreciation which will be charged. Pankaj Kumar has given the entire computation also. Wow. Very good, Pankaj. Okay. So the asset is put to use on 1st April 2023. Asset was purchased on 1st November 2022. I'm asking you, what is the depreciation which is to be charged in financial year 22-23? What is the depreciation which is to be charged? Oh, Om, Aditi, Yogesh, Pankaj. Very good answer. Ravi Gupta is nalayak. He's saying 20,000. The answer is nil. The answer is 0. You will not charge any depreciation because the asset is not put to use in financial year 22-23. All right. And now tell me, guys, what is the depreciation which is to be charged in financial year 23-24? What is the depreciation which is to be charged in financial year 23-24? What is the depreciation? Amount of depreciation is 20,000 rupees. What is the depreciation which is to be charged in 23-24? The amount of depreciation is 20,000 rupees for financial year 23-24, which is the next financial year or the previous year. Perfect. Very good. Now I'll change the question a little bit, okay? I'll change the question now, okay? So, the asset is put to use on 1st December 2023. The asset is put to use on 1st December 2023. Yes, even after 1 year, the asset was put to use on 1st December 2023. Now guys, in this particular part, please tell me what is the depreciation which is to be charged in 22-23. What is the depreciation which is to be charged in 22-23? In the financial year 22-23, what is the depreciation which is to be charged? Again, the answer is 0. Again, the answer is 0. In 22-23, there is no capitalization which is happening. There is no capitalization. Therefore, there is no depreciation in 22-23. The depreciation in 22-23 is nil. Yes, very good. Depreciation in 22-23 is nil. Nil, nil, nil. Perfect, nil. Perfect Om. Perfect Kirti. Perfect Vanshi. Deeptesh. Ranojit. Karthik. Rishabh. Rishabh is wrong. How did he arrive at 25,000? I don't know. Meraki is wrong. Aditi right. So financial year 22-23, the depreciation is 0. Now, my critical question. What will be the depreciation for 23-24? What will be the depreciation of 23-24? What will be the depreciation for 23-24? What depreciation will you charge in 23-24? So 22-23, there is no capitalization, therefore no depreciation. What will be the depreciation in 23-24? Will it be 10,000 or will it be 20,000? Pankaj is saying 10,000. Karthik is saying 10,000. Deepika is saying 10,000. 22-23 is 0. 22-23 depreciation is 0 because in financial year 22-23 there is no capitalization which is happening. Therefore, 22-23 is 0. What will happen in 23-24? The answer is 20,000. But why, sir? In year 23-24, the put to use is less than 180 days. In the year 23-24, the put to use is less than 180 days. Then, sir, why didn't you do half over here? Guys, the principle of half is only and only applicable when the year of purchase and year of put to use is same. Please tell me in this particular case, what is year of purchase? Guys, the year of purchase is 21-22. This is the year of purchase. And what is the year of put to use? Year of put to use is, so year of purchase is 22-23. Year of purchase is 22-23. And what is the put to use year? Put to use year is 23-24. Put to use year is 23-24. When put to use year is different from purchase year, when put to use year is different from purchase year, then this concept of 180 days more, 180 days less is not applicable. Then, guys, entire depreciation is given in the year when it was put to use, if the put to use is a separate year, or if the put to use is a different year. The concept of 180 days more or less is only applicable where the year of purchase and year of put to use are one and the same years. If the years are different, purchase year is different, put to use year is different, then, guys, the 180 days rule doesn't apply. Even when the assets are used for less than 180 days, full depreciation is chargeable. Full depreciation is chargeable. Okay. Now we come on to the depreciation rates. So what are the depreciation rates which are specified under the Income Tax Act? That is what we are going to discuss now. And so, would these depreciation rate differ according to the will of the assessee? Can assessee say that in my case the depreciation rate is different? Answer is no. The depreciation is fixed. The depreciation rates are fixed as per the Income Tax Act, and those depreciation rates are the fixed depreciation rates which we are going to study now. So the depreciation rates which are there as per the Income Tax Act are spread into these blocks. These are known as block of assets. Okay. So first block is building block. So if your building is a residential building, then the depreciation is 5%. If your building is a non-residential building, which is a commercial building, which includes hotels, boardings, godown, office, factory, etc., then 10% is the depreciation rate. And any temporary construction means any kind of temporary sheds are laid, or some some steel roof is there, or some roof is there which is temporary, which is not made of cement and the pakka material, then, guys, those temporary constructions are eligible for 40%. They are eligible for 40% depreciation. No, Ishita, we don't count months in case of depreciation. In case of income tax, we don't count months. Either it is more than 180 or it is less than 180. That's it. We don't count months. Full depreciation or half depreciation. Months are never counted. So furniture, the depreciation rate is 10%. Furniture, the depreciation rate is 10%. Intangible assets like goodwill, like any kind of asset which you cannot touch or see, that depreciation rate is 25%. It includes patent, trademark, license, etc. Then plant and machinery. This is the most critical block. And sir, do we have to remember all these rates? Yes, guys. Most probably your examination question will contain the rates which are specified, but still you should remember these rates. So rates are: oil wells 15%, ocean going ships, vessels, speedboats 20%, motor car, lorry, bus used for hiring purposes 30%, computer including software, books owned by professionals 40%, air or water pollution control equipment 40%, any other kind of plant and machinery 15%. So guys, the most critical rate which is there on this particular chart is the others. You should remember that other plant and machinery which is not specified plant and machinery is generally chargeable as at 15% rate. So if the question is silent on what kind of plant and machinery is it, you should always take the rate as 15%. 15% should be the depreciation rate. If the question is silent that what rate is there, then you should always take 15% depreciation rate. Okay, so now we come on to the concept of additional depreciation. Now this is a very, very important concept, guys. In certain circumstances we give depreciation over and above the original depreciation. So original depreciation is of course applicable, original depreciation is of course provided, but over and above the original depreciation, additional depreciation is also levied in certain plant and machinery. In certain cases, additional depreciation is also levied. So additional depreciation, the rate of additional depreciation is 20%. Yes, in your books there's a rate which is given for notified backward areas, which is 35%. But guys, that rate is the old rate, because that deduction is now not available after 31st March 2020. That deduction is not available. So now the deduction which is applicable in your case is only 20% of additional depreciation deduction. What do you mean by additional depreciation, guys? Additional depreciation means if you are doing certain specified businesses, then we will give you something extra as depreciation apart from the original depreciation. So obviously, higher the depreciation, lesser will be your PGBP, lesser will be your taxes. Let me repeat, higher the depreciation, lesser will be your PGBP, lesser will be your taxes. So guys, we want higher depreciation, we want additional depreciation, and that additional depreciation is eligible for a deduction. And guys, that deduction is eligible in form of additional depreciation at the rate of 20% on plant and machinery, only and only if you specify certain conditions, not in every circumstance, not in every circumstance. So guys, the original depreciation on plant and machinery is 15%. If we add 20% of additional depreciation, it gives me a depreciation of 35% in the first year itself. So additional depreciation is only eligible for the first year when you purchase some new plant and machinery. When some new plant machinery is purchased by you, then additional depreciation is levied only in the first year, in the year of purchase, because the government of India wants to motivate young entrepreneurs to buy new machinery, to buy new technology and start their work, start their businesses. So in pursuit of having more and more entrepreneurs leading their way to start their own businesses, government of India has started the concept of additional depreciation. Now, business undertaking must have been established on or after 1st of April 2005, on or after 1st April 2005, then additional depreciation is available only once in lifetime in the year of purchase of the assets. Then in case purchases during the year have been put to use for less than 180 days, 50% of the normal rate is eligible. So guys, before coming on to these are miscellaneous provisions. Okay, let me first discuss the main provisions which are there. Okay, these are the miscellaneous provisions. We'll take them separately. So it is available to all the assessees engaged in the business of. So additional depreciation is available to all the assessees who are eligible, who are engaged in the business of manufacture or production of article or thing. So the assessees who are engaged in manufacture or production of article or things, this depreciation is eligible, additional depreciation is eligible for those assessees. Then those who are involved in generation and transmission or distribution of power. So if you are into electricity business, then also additional depreciation is eligible to you. Available on new plant and machinery. So if you purchase second hand plant and machinery, then additional depreciation is not eligible for you. Only new plant and machinery if you have, then only additional depreciation is eligible. Acquired and installed after 31st March 2005. So whatever machinery, new machinery you have purchased, you have acquired and installed those machinery after 31st March 2005, only then this additional depreciation will be eligible to you. Guys, obviously, as a businessman, I would want additional depreciation so that my profits are reduced, so that my taxes are reduced. I want additional depreciation. Then plant and machinery does not include. So what plant and machinery are not eligible for additional depreciation? If they are not eligible for additional depreciation, then obviously original depreciation they will be eligible for. Okay, original depreciation you cannot say that the company is not eligible for original depreciation, but additional depreciation, plant machinery, certain plant machineries are not eligible for additional depreciation. So plant machinery does not include ships, aircrafts, appliances, road vehicles, office transport vehicles, plant and machinery installed in residential accommodation, in office premises, they are not eligible for additional depreciation. If plant machinery is established or installed in guest house, they are not eligible for additional depreciation. So additional depreciation will not be eligible for these plant machinery which are installed in these areas. Then if the plant machinery is second hand, then that is also not eligible for deduction, additional depreciation. Then plant machinery on which 100% deduction has already been claimed. So there might be certain plant machinery where you have already claimed special deduction, which means that entire amount of capital expenditure has been allowed as a deduction. So special expenditure has already been claimed for that plant machinery, then additional depreciation will not be allowed for that particular plant and machinery. So plant machinery on which 100% deduction has already been claimed, those plant and machinery are not eligible for additional depreciation. So additional depreciation not eligible for plant machinery which are not 100% deductible. So 100% deduction allowed, plant machinery will not be eligible for additional depreciation. Now we come on to these additional points, guys. So these additional points are, so the first point is that the additional depreciation, now the most important point is additional depreciation is also split into two parts. If the new asset is being purchased and used for less than 180 days, then the additional depreciation will also be split into two parts. 50% will be available in the year of put to use, and 50% will be available in the subsequent year. So in a nutshell, 20% will not be available in the year of purchase. 20% will be split into two parts, 10% and 10%. 10% will be available in the year of put to use, 10% in the subsequent year. If in the year of put to use, the put to use of the plant machinery has been done for less than 180 days, then in that case the depreciation will be split into two parts. Okay, this was the story of additional depreciation. All right, now we come on to a very, very important topic of our syllabus, guys. The topic name is slump sale. Okay, the topic name is slump sale, and I'm going to discuss this particular topic in great detail in capital gains chapter also. This topic is related to capital gains chapter as well as the chapter on PGBP. So both these chapter contains this concept called slump sale. Now, guys, what do you mean by slump sale? Slump sale means sale for a lump sum consideration. Sale of assets for a lump sum consideration. I'll give you an example, and by example, I will make you understand what do you mean by slump sale. All right. So, guys, this is a fixed assets details of a particular business. Okay. This is the fixed asset details of a particular business. Please see this chart. Okay. X Limited has got three units, unit A, unit B, unit C. X Limited has got 3 units, unit A, unit B, unit C. X Limited has 3 block of assets, machinery, building, furniture. Okay. Unit A has 2 machinery, unit A has 1 building, unit A has 4 furniture, unit B has 2 machinery, unit B has 1 building, unit B has 3 furniture. Okay, I've given numbering to the individual assets which are there in a particular unit. Unit C has one machinery, unit C has two buildings, unit C has 4 furniture. Now, suppose unit B is getting sold. Suppose unit B is getting sold for a lump sum consideration of 16 lakh rupees. Unit C is getting sold for a lump sum consideration of 16 lakh rupees. Unit B is getting sold. Unit B is being sold for a lump sum consideration of 16 lakh rupees. We are selling off unit B. Lump sum consideration is being received. 16 lakh rupees is received for all the assets. For all the assets. Now the problem is we have not allocated this sales proceed amongst individual assets. We don't know how much have we sold M3 for. We don't know how much have we sold M4 for. We don't know how much have we sold B2 for. We don't know how much have we sold F5 and F6 for. We don't know the individual sales consideration of each of the asset. Sir, why do you want to know the individual sales consideration of each of the asset? Why do you want to know? Why can't we be okay with the total sales consideration, which is 16 lakh? 16 lakh is the total sales consideration of unit B. Why do you want to know individual sales consideration? Guys, I want to know the individual sales consideration. Why? Because I've already told you, while computing depreciation, I need to reduce the sales consideration in my fixed asset register. So this is a fixed asset register of this particular entity X Limited. Please see this register. This contains the individual assets, the individual blocks at the top. Then there are assets M1 to M5, B1 to B4, F1 to F11. There are assets which are there in each of the blocks. Opening WDV is given. Sales consideration of assets sold individually. If the asset is sold individually, I have no problem. I will reduce this particular block from the individual sales consideration. That is not a problem. But guys, when the asset are sold on a lump sum basis, then 16 lakh rupees is derived from this entire section, right? Now my problem is that I cannot reduce 16 lakh from the entire 3 columns. I need an individual figure for column 1. I need an individual figure for column 2. I need an individual figure for column 3. I need individual figures for all these columns. I do not have individual figures. I have only one lump sum figure, which is 16 lakh. Now you tell me whether 16 lakh will be reduced from machinery, whether 16 lakh should be reduced from building, whether 16 lakh should be reduced from furniture. What should I do? I'm in a problem. I need to reduce this 16 lakh. How can I split this 16 lakh into 3 parts? I'm unable to do it. I have a problem over here. I'm unable to do it. So if you are unable to do it, then what does Income Tax Act tells you? Income Tax Act says, okay, for the assets which are sold as a lump sum consideration, for the assets which are sold as a lump sum consideration, you reduce WDV of those assets which are sold for lump sum consideration. Whatever is the WDV of that particular asset, you should sold for, you should reduce it over here. So what do you mean by that? So we didn't understand. I'll make you understand. Okay, I'll make you understand. Please see this. Okay. So guys, we are selling M3 and M4. We don't know the individual sales proceed of M3 and M4, but we are selling M3 and M4. I don't know what is the individual sales consideration of M3 and M4. I don't know that because the total consideration is given to me, which is 16 lakh. I don't know what is the consideration for M3 and M4. I don't know that. Income Tax Act says, okay, do you know the purchase price of these two assets? We say, of course, yes. We have purchased this 4 years back. We know the purchase price of these two assets. Suppose the purchase price of these two assets, is 2 lakh rupees. The purchase price of these two assets is, suppose, 2 lakh rupees. Suppose the purchase price of these two assets is 2 lakh rupees. Now, Income Tax Act asks you to reduce the depreciation which would have been leviable on these two assets if they were a different block altogether. So, which means that, suppose this is a machinery block, okay? And in the machinery block, guys, the depreciation which is to be charged is 15%, okay? So, 15% is charged on this particular asset on a WDV basis. So, I'll get my calculator, okay? So, 2 lakh rupees is the purchase price minus 15%, 1,70,000 minus 15%, 1,40,000. 44,500 is the WDV. Notional WDV. 1,44,500 is the notional WDV. So Income Tax Act is telling you that, okay, in case of lump sum consideration, in case of slump sale, you reduce the WDV of the assets sold on slump sale, because we do not know the sales consideration of these individual assets. So the Income Tax Act is giving us a shortcut. You can reduce the WDV of the individual assets and compute your amount of depreciation using that WDV. So WDV is the amount which we will reduce from each of these blocks. Instead of sales consideration, if the assets were sold individually, then obviously we would have reduced the sales consideration. But in this case, we don't have the sales consideration. So guys, we will reduce the assets which are sold on lump sum basis, their WDV is sold. Please read the formula carefully. Original cost of asset minus notional depreciation. Whatever is the original cost of asset, we will reduce the notional depreciation from that original cost of asset, and that should be reduced as WDV of the assets which are sold on lump sum basis. This is known as slump sale. A small variation is required to be done. Why? Because we do not know the individual prices of each of the asset in case of slump sale. So a small difference is there in computation of the depreciation as per the slump sale. So this is the concept of slump sale. And yes, we are going to deal with this concept again in our chapter on capital gains. So yes, guys, this was our section on slump sale. And yes, today we are going to pause over here. We have covered a fair bit of portion today in this particular class. Guys, a request to all of you. What is the request? Request is, please do the questions which are given in your study mat of the Institute of Cost Accountants of India. In the study mat, you should do all the questions which are given in the study mat. And guys, the study mat contains the questions, and those questions are very, very important from an exam standpoint as well. Doesn't matter from where have you taken coaching, whether you have taken coaching from a CMA specific teacher or a CA teacher also, that doesn't matter. But you have to solve all the questions which are given in the study mat of the institute. All the questions which are given, practical questions which are given in the study mat, please solve those questions till this point, okay, till slump sale. Solve all the questions till slump sale. Do all the work, do all the questions which are there, do all the concepts which are there till this particular point, okay? And in the next class, we are going to continue from here. Next class, we'll be covering a very major portion of our PGBP chapter. So in the next class, we'll be covering all the entire concepts which are remaining. If you like the video, please hit a like button, guys, before we sign off, before we leave. Let's like this particular video. Please like this video before we leave. I want you to like this video. And yes, do subscribe, share this video with your friends if you like these videos. It also motivates me for continuing these kind of sessions. Please hit a like button if you like this particular video. And yes, guys, we'll be meeting in our next session. The next session is scheduled on Thursday. And yes, Sunday we have test of PGBP. Sunday we have test of PGBP. So Sunday we'll be having this test. And yes, God bless all of you. God bless. And yes, Navratris are on. Again, a gentle reminder to all of you. Start something new during Navratris. It will yield a lot of fortune. It will yield a lot of good results for you. Start something new. Like start some new subject. Start a fresh revision during Navratris. And it will yield very positive results for all of you. On that positive note, please hit a like button if you like these videos. And yes, do subscribe the channel. And yes, do share it with your friends. On that positive note, all the very best and happy studying. Bye-bye. Bye. Rishabh is requesting on my behalf. Very good, Rishabh. Diptesh, thank you. Thank you, Saksham. Thank you, Deepika. Thank you, Kartike. Thank you, Kirti. Thank you, Sumit Ghosh. Thank you, Yashika, Sarneka, Kirti, Ishita. Thank you, everyone. And bye. And see you in the next session, which is scheduled on Thursday. See you all.